Turn on a faucet anywhere in a developed city. Water appears. Every time. Day after day. Year after year. Most people never think about it. Which is remarkable, because behind that 5-second interaction sits one of the largest infrastructure businesses ever created. A business where customers cannot realistically cancel. A business where demand exists whether the economy is booming or collapsing. A business so essential that governments regulate it, investors love it, and societies panic when it fails. Yet despite supplying the most important resource on Earth, many water systems generate surprisingly modest profits. That's the contradiction. Everyone needs the product. Almost nobody gets rich quickly selling it. By the end of this video, you'll know exactly how water supply systems make money, why some investors consider them the ultimate infrastructure asset, and how a handful of operators quietly built multi-billion-dollar empires by controlling something most people expect to be nearly free. Let's start with the entry fee. Because this is where the fantasy disappears. People imagine a water company as a treatment plant and some pipes. That's like describing an airline as a collection of seats. Technically true. Economically useless. A modern water system is one of the most capital-intensive assets on Earth. First comes the water source. Reservoirs, rivers, aquifers, desalination facilities, water rights. Then comes treatment, filtration plants, chemical systems, pumping stations, monitoring equipment, laboratories. Then comes distribution. This is where the real money disappears. Thousands of miles of underground pipe, storage tanks, pressure control systems, emergency backups, repair crews, control centers, metering infrastructure. And unlike a refinery or factory, most of it is buried underground where nobody can see it. Which means owners spend billions on assets that customers never notice. A medium-sized city can easily require several $billion of water infrastructure. Large metropolitan systems can exceed $50 billion. Some exceed $100 billion. The numbers become absurd. The water infrastructure serving cities like New York City or London represents generations of investment accumulated over more than a century. Entire networks of tunnels, reservoirs, treatment plants, and distribution systems. At that scale, you're no longer building utilities. You're building civilization. Then comes maintenance. A restaurant can replace a broken appliance. A water utility might need to replace 20 miles of century-old pipe beneath busy streets. The bill can exceed hundreds of millions of dollars. And unlike many industries, postponing maintenance usually makes the problem more expensive. Water has patience. Infrastructure doesn't. The summary is simple. The hardest part isn't finding water. It's building everything required to move it. Now let's look at how the money actually works. Imagine a vending machine. You install it once. Customers repeatedly pay for access. The machine quietly generates revenue for years. Water systems operate similarly. Except the machine is an entire city. Customers pay recurring fees. Water flows. Bills arrive. The cycle repeats. The industry term is regulated utility revenue. And it's one of the least exciting phrases in finance. Which is exactly why investors like it. Let's simplify it. A utility spends $10 billion building infrastructure. Regulators allow it to earn a specific return. Maybe 8%. Maybe 10%. The exact number varies. The utility recovers operating costs. Recovers capital expenditures. Then earns an approved return on invested capital. This changes the entire business model. Most companies earn more by charging higher prices. Water utilities often earn more by building more infrastructure. Think about that. A software company wants users. A retailer wants customers. A water utility often wants regulatory approval for another billion-dollar upgrade project. Because that project becomes part of its asset base. And the asset base generates future returns. The industry calls this the rate base. The rate base quietly controls the economics of the entire sector. Bigger asset base. More approved returns. More predictable earnings. It's a remarkably simple formula. The customer sees a water bill. The owner sees a regulated financial machine. That's an important distinction. Now for the hidden layer. Because this is where most people misunderstand the industry. The casual observer thinks water companies sell water. They don't. At least not primarily. They sell reliability. Consider this. Most households consume relatively little water compared to the value they receive. A family might pay $50 to $150 monthly. Yet uninterrupted water service supports cooking, cleaning, sanitation, health, landscaping, industry, and daily life. The value delivered is far greater than the bill. Which means reliability becomes everything. The customer doesn't reward excellence. They punish failure. Nobody calls the utility to congratulate it for delivering water today. They call immediately when water stops arriving. This creates a fascinating business incentive. The best-run systems often appear boring. No headlines. No emergencies. No surprises. Infrastructure investors love boring. Boring pays dividends. There's another hidden layer. Population density. A utility serving 1 million people in a compact city often enjoys better economics than a utility serving the same population spread across vast rural areas. Why? Because pipes are expensive. Distance is expensive. Maintenance is expensive. Every additional mile of infrastructure adds cost. Dense customers generate more revenue per mile of pipe. The public sees neighborhoods. The utility sees asset efficiency. That's where profitability begins. Then there's data. Modern water systems increasingly use sensors, predictive maintenance software, smart meters, pressure analytics, and leak detection technology. A small leak ignored for years becomes a financial problem. A major leak becomes a political problem. Technology allows utilities to identify issues before customers notice them. The public sees water. The operator sees data. That's the hidden business model. Now let's talk about why smart people still fail. Because infrastructure does not forgive mistakes. Failure pattern number 1. Underestimating maintenance. This is one of the oldest mistakes in utility history. Executives postpone upgrades. Governments delay investments. Budgets look healthier temporarily. Then reality arrives. One famous example occurred in Flint. The crisis involved multiple factors including infrastructure management decisions, water treatment issues, and oversight failures. The financial consequences reached hundreds of millions of dollars through lawsuits, repairs, emergency responses, and long-term remediation efforts. The epitaph. Saved money temporarily. Spent far more later. Infrastructure debts always collect interest. Failure pattern number 2. Building capacity nobody needs. This happens surprisingly often. Forecasts predict growth. Utilities build accordingly. Growth never arrives. Debt remains. One notable example involves several large desalination projects around the world that were constructed with expectations of future demand and drought conditions, only to operate below anticipated capacity for years. Some projects cost billions. Revenue projections disappointed. The infrastructure existed. The customers didn't. The epitaph. Built for tomorrow. Waited years for tomorrow to arrive. Infrastructure assets age whether they're used or not. The summary is straightforward. Wrong forecasts can be as expensive as broken pipes. Now for the payoff. Let's assume a smaller scenario. You own a regional water utility serving 100,000 customer connections. Average annual revenue per connection equals $800. Total annual revenue reaches approximately $80 million. Operating costs consume a substantial portion. Debt service consumes more. But regulated returns provide stability. Perhaps annual profit reaches $8 million to $15 million. Not dramatic. Just consistent. Infrastructure investors appreciate consistency. Now let's scale up. Imagine a major utility serving 5 million customer connections. Average annual revenue reaches $1,000 per connection. Revenue approaches $5 billion annually. Which brings us to one of the industry's modern titans. American Water Works. The company serves millions of customers across the United States and manages tens of billions of dollars in regulated infrastructure assets. Its success wasn't built on innovation in the way Silicon Valley understands innovation. It was built on acquiring systems, improving operations, investing in infrastructure, and expanding asset bases over decades. Patiently, methodically, the result became one of the largest investor-owned water utilities in the world, with a market value measured in tens of billions of dollars. Not because it sold luxury products, because it sold necessity. And that's the real lesson. The economics of owning water supply systems aren't about water. Water is the visible product. The real business is reliability. It's infrastructure. It's regulation. It's asset management. It's convincing millions of people that the most important service in their lives should be so dependable they never think about it. Most businesses fight for customer attention. Water systems succeed by becoming invisible. No headlines. No excitement. No drama. Just water appearing every time someone turns a handle. And that may be the ultimate infrastructure business. Because when customers only notice you when something goes wrong, perfection looks exactly like nothing happening at all. Repeated millions of times. Every single day. 4 generations.